Hello and welcome. You're watching All About Your Company here on ET Now. I'm Harsh Saita. Very quickly, today we're going to be talking about Canfin Homes. Of course, Q3 numbers were extremely strong for a Canfin Homes. But more importantly, I'm trying to understand the medium to long-term roadmap, and especially within that roadmap is the sustainability of the kind of ROA they've clocked. They've clocked 2.5% or nearly 2.6% in terms of ROA. The guidance is 2.2, so this 30 to 40 bips beat. I'm trying to understand whether that's just temporary or not. So we'll try and understand first off the sustainability of that number. Second, what I want to also know is the growth trajectory that the company takes, because growth has been at around 10%. The aspiration is to go towards mid-teens. I'm trying to get to when does that happen and whether that is realistic. And how should one expect that to play out in terms of geography as well? How does geographic diversification play towards the growth that they are looking for? And where do they go from this 40,000 crore odd in terms of the AUM number? The third piece I spoke about is geographic diversification. The fourth piece is with regard to diversifying distribution. They've spoken about how they are heavily reliant on direct selling agents, how the move away from that is going to play out, both in terms of time period, how it moves away, and cost, whether the cost structures change at all if that were to play out. Currently, heavily reliant, as I said, on direct selling agents. I'll explain that while we're understanding the company better. The fifth piece is with regard to self-employed, whether the book, which has run up in terms of the overall loan book mix, what's the kind of risk there, and whether there is any cause of concern there? How are we controlling risk, or how is the company controlling risk, especially on this part of the book? And of course, along with it, what could the normalized credit cost, and number 6, how would the asset quality really shape up? Because we've seen a bit of an inch up with regard to the NPA ratios. No concerns, but we've seen that inch up, so I'm trying to understand also the trajectory there. Now let's talk about the company, and we'll start off by understanding that this was, of course, a Canara Bank incorporated company. It's the promoter of Canfin Homes. It's a deposit-taking housing finance company, and that gives it some advantages as well, given that they can diversify their liability book and the source of funds available to them are more than some of the others. When you're looking at the branches, the spread is quite decent, nearly 250 branches across 21 states. That's all of the products that they do that you can see on your screen. The loan mix, in fact, 73% is housing, 11% is housing and within the commercial bracket. Then there's LAP and mortgage, which is at around 8%, and then there's others, which is also 8%. I think there's a 6 and a 2 split even within the others, but we'll club it at 8 over there. So broadly, that's the split. Fairly secured, most of the lending that they do. In terms of the loan book distribution, this is where the tilt goes up as well. 73% is south focused. There is also some hint of north, which is around 20% overall. 80% is south, 20% is north. That was the aspiration to get to. They've got to that, but I'm also trying to break west, east and central, and within that bracket you'll see the west coast is around 11% odd, and central plus east is around 3%. So very small in terms of its presence in those areas. I'm also going to try and understand whether the growth tilt will move in favor of that, and disbursements at least reflecting that already. How do they sell? This is important. I spoke about the distribution mix, and direct selling agents is 79% currently. It was 80% last year. Shift here is obviously more difficult. Direct walk-ins is around 14%, and then there's the marketing team, which pushes out around 7% odd of the loans. Who do they sell to? Again, the cohort of customers is also important, because it gives you the nature of the lending that they do, and what are the default risks of that lending. Salaried private is around 54 odd percent. Self-employed is around 30%. This has gone up, and this is non-salaried self-employed. And then you have government employees and PSBs, PSB related employees. PSU banks plus salaried professionals both combined is just 2%. So that's broadly the breakup. Now let me talk quickly about how the journey has been for this NBFC. You look at the last 3-year CAGR in terms of the net interest income, it's up 18% over the last 3 years. Some part of it is the margin lift that the company has got. So of course, it's benefited from that, and also asset quality is decent, but growth lift is what is necessary, and we'll try and understand that better. Operating profit also is up around 19%, 3-year CAGR. The provisions number has largely been steady. There's been no concern there. There's not been any sharp spikes over there, so that's a positive as well. And profitability has gone up by 22% CAGR, so fairly decent in terms of its compounding story. Let's talk also about the AUM and the balance sheet metrics. In terms of those, the AUM has gone up by around 13%, 3-year CAGR in terms of the AUM from 26,500 crore approximately in FY22. We're currently sitting at a 40,000 crore AUM. So that's really the glide path that they've taken. Disbursements have been fairly steady, but capital adequacy, which is important, is at 25%. So can they grow faster? Well, capital adequacy certainly seems to allow them to do that. So we'll understand that better as to how that kind of plays on growth going forward as well. Let's talk about loan yields. And when you're looking at, and this is the operational metrics, of course, the loan yields have gone up from the 8% number to the 10% number. In fact, if I look at the FY22 onwards, far better graph to look at, 8% to around 10 odd percent. You look at the margins also, it's seen a lift from 3.5% margins to currently sitting at 4.14%. Now, I believe that this is a bit elevated. The guidance is 3.75. I wonder if this comes back off as the rate cycle starts to mature, and we'll try and get a sense as to how that plays out on the numbers. The cost to income, very, very controlled, very steady. You're looking at anything between 17 to around 20%. That's the cost to income ratio. So that too is fairly stable. Give credit to the management for that. When you're looking at the spreads, again, the guidance is 2.75. They're doing near 3% now, 2.93%. But they've inched up from 2.5% to 2.75. Now, in terms of 2.93, in terms of the guidance, generally it's got a good track record of following guidance. At least last year, since Mr. Suresh Iyer has taken over, guidance has largely been followed. So that's something you really want to track if you're a shareholder. You look at the gross stage 3 and net stage 3, they've inched upwards, of course. I want to know whether that's a permanent inch up, and is there comfort on that front on maintaining this kind of 0.9% kind of net NPA, because, or rather gross NPA, because traditionally it's been around 0.5%. Same with the net NPA, we've seen a bit of an inch up versus what has been a 0.3% net stage 3 traditionally that we've seen. In terms of the return ratios, also we've seen an inch up along with that. So that's a key positive. We've seen a return ratio which used to be an ROE, which used to be around 15% in FY22, inch up towards 19% now. Again, a lot of this will also depend on margin, so you want to keep your eye out on that margin number. In terms of shareholding now, let's talk about that. Look at the promoter holding, it's at around 30%, very, very stable, because you've got Canara Bank as the promoter who's coming in. There is FI, DI participation, there's also public participation, and largely you've seen, and this is unique, viewers, where the number of shareholders have actually come off. There were over a lakh of shareholders around a year or so back. We've seen now the number of shareholders come off, which means that there's some bit of interest coming off from the retail cohort, which is that while public shareholding has remained fairly stable, but you've seen the retail shareholding come off from the 33.5% number to around 32%, and therefore you've seen a taper down with regard to the number of shareholders. That's something you want to be mindful about. In terms of valuations, well, the book value is at around 410. The company does around 60 rupees of EPS, at least trailing 12 months, and therefore what you've seen is a current price to book for around 2.2. But if you're looking at the market price of 919 and you're looking at 1 year forward, it's trading at around 1.8 times. And we're taking FY27 forward, because now very quickly Q4 will start to get priced in as well. You look at analyst ratings, and mind you have to contextualize the valuations also with the kind of growth that the company is offering. We're doing slightly subpar growth, so that's something, if that were to meaningfully change, you could see that valuation lever change fairly quickly, but we're cautious with regard to valuations. You look at the buy-sell holds on this one. 2 holds and around a 9% return potential is what analysts are penciling in with regard to a Canfin Homes. But let me take it across. We have with us Mr. Suresh Iyer, Managing Director and CEO. But what we'll do is we'll sit in a very short break. We'll take that break, come back in conversation with Mr. Iyer. Stay tuned. Canfin Homes, you'll get a snapshot of that on your screen. We'll also have Mr. Suresh Iyer, who's coming in and giving us a perspective on what to look forward to in terms of Canfin Homes. Mr. Iyer, always great chatting with you. First off, let me start off with this kind of margin number you've clocked this quarter. Temporary, you reckon? Will we start to see margins edging off? If at all there's no further repo rate cut, is that something we can pencil in? And how much of this margin number will you retain? Give us a perspective on that as well.
See, actually, we've got last quarter itself, we had indicated that we have a scope to pass on about 10 bips to our customers. And we did pass on 10 bips in December from 1st of December. But again, we had another 25 bips rate cut, which has come from the RBI. So we feel there is another scope for, so effective January, we passed on another 15 basis points. So whatever is the benefit that we will be seeing because of this rate cut, that we have entirely passed on. So I believe this is the kind of level that we should be able to maintain, and further, uptick from here will be a little difficult, or rather, we would rather pass on whatever additional benefit that we get back to our customers. So around 2.75 spread is what we have, and 3.75 NIM is what we have guided for. We are presently in both these elements better. So I think 2.75 to 2.8 for spread and 3.75 to 3.8 for NIM is what I think in Q4 we can definitely, continue.
No, Mr. Iyer, sorry, maybe I'm re-emphasizing this. So you're currently at above 4. You're saying that you'll virtually be able to retain everything, maybe just about 15 bips is what you will give up. So 4% should be the NIM, therefore.
No, that's for the quarter NIM. In fact, if you see, there's also a timing aspect to it, because we had a 10 bips benefit, which we had indicated we can pass on. But we didn't pass on in the month of October and November because we were still negotiating for the rate cut benefit to get transmitted to us. Now, having done that, we passed on 10 bips in the month of December. So basically, we did get the benefit in the first 2 months, which is where you can see that for the quarter, the NIMs are at 4.14. But having said that, if you look at the 9-month NIM, then that is at around 3.89. So basically, we are talking about the full year's report where we will be ending around 3.8 roughly in terms of the NIM. Because in Q4, whatever is the benefit we have already received because of this rate cuts, we have passed on effective 1st of January. So effectively in Q4, this 4, it will be around 4, but for the full year, it will still be around 3.8 or something.
Fair, and therefore for FY27, are you better placed to give a 4% margin guidance?
No, we would still, in terms of the guidance, keep it around 3.75 to 3.8 because, if at all we get some benefit, we would pass on to our customers.
Okay, sure. With regard to the AUM, you were at 38,200 at the start of this financial year. You're currently at around 40,600. Would you say you've underperformed, at least for the first 3 quarters, even though third quarter has been reasonably good for you? You've done 2.5% QOQ, so that's fairly decent. But the first 2 quarters were a bit of a drag, and we've not seen the kind of tailwind that we would want to, at least starting H2. So would you say that it's probably disappointed for you?
See, in terms of the disbursement which we had planned for the entire year, we are on course for it. It's normally 45% in H1 and 55% in H2. So in line with that, we have actually performed. However, what has slightly affected us is that our prepayments or loan closures in Q2 as well as in Q3 have been a little elevated. We had originally planned for around 1,400 crores of rundown in each quarter. But in fact, our rundown in the second quarter was 1,661 crores, and in the Q3 it is 1,691 crores. So basically, about 400 crores out of rundown has been more than what we had originally anticipated. So that's what is actually pulling down our AUM growth. But in terms of the disbursement growth, it is in line because we had guided for 10,500 crores for the full year. We are at 7,000, close to 7,300 crores, and we are planning for 3,200 to 3,300 crore in Q4, which we are quite positive we should be able to achieve.
So now you're on a lower base, even though you've done disbursements. What's the kind of growth roadmap for the next 3 years? So maybe if you're looking at the AUM growth for full year, you'll probably be at 10%. FY26, is that the way to look at it? And thereafter, what's the kind of growth roadmap you look at for the next 2 to 3 years?
We will plan for around 13,500 crore disbursement for next financial year, which should, considering the elevated level of loan closures and BT outs also, we should be able to get around 15%. We would definitely would want to push for that only. And this year also, in fact, we will have a slightly better than 10% to closer to 11 or closer to 12%, 11% plus by the end of the Q4, because last year we had about 2,500 crores of disbursement in the last quarter, whereas in this quarter we are looking at around 3,300 crores. So that growth is also slightly higher. So which should help us in our AUM growth in the Q4. So if you see in Q2, we ended with around 8.4% AUM growth. But in Q4, because of our higher disbursement, we have been able to push it up to closer to 10%. And same way in Q4, when the disbursements will be at around 3,300, we should be closer, we should be 11% plus.
Any reason why the prepayments have been elevated?
Obviously, it's the rate cuts which, we as an intermediary do not get the entire 125 basis points benefit in our borrowing cost. What gets transmitted to us is only in respect of the, floating rate or EBLR linked loans on the bank side, because on our NCDs are fixed rate, deposits are fixed rate. NHB, of course, it is not an equivalent amount of reduction, and it's also an annual reducing thing. So there's a delay in the rate transmission from NHB refinance also. So basically, 40% of our total borrowing is linked to EBLR and the bank borrowing. So that 40% is what we get. So effectively, when the 125 basis points reduction in repo rate has transmitted to, has effectively been about 50 basis points for us on our bank borrowing side, which we have passed on to our customers as well. So basically, in the beginning of the year, we were offering rates at around 8.85, which was around, compared to 8.4, which the banks were offering before the rates cut started. We were about 55 to 60 basis points higher than what the banks were offering. But now the banks have passed on the entire 125 basis points, whereas our pass on has been only about 50 basis points. So the gap has slightly increased, which is resulting in our prepayment slightly going up. Of course, on our side, the thing is that we also have some annual reset portfolio, which we are trying to move to quarterly reset so that, the customers get the full 50 basis points advantage. Once that transmission entirely happens, I think this should slightly come off. The prepayments and BT out should slightly come out, because basically customers do understand that there is a difference between a housing finance company and a bank, but at least they expect some benefit to be passed on, which in an annual reset happens a little later. So our endeavor is to move our entire annual reset portfolio to quarterly reset so that the customers get the full 50 basis points that we have passed on.
Got it. With regard to credit cost, no concern at all, at least the way I'm seeing it. Talk to us about the non-salaried self-employed, that portfolio. How is it behaving for you? Any concerns that you're seeing on that portfolio? Because now it's becoming large. And is there scope for expansion of that portfolio further, just strategically from a margin standpoint?
Compared to the salaried segment, the self-employed does have a slightly higher, NPA level. But having said that, if you look at the last 8 quarters, our, GNPA in our self-employed portfolio has been very range bound between 1.6 to 1.7%. So therefore, we don't see much of a change or any stress in that portfolio. It has been the regular thing. And if you see the movement in the portfolio has also been like that. So there are big cases which move into NPA, but the rollback also is equally higher in the self-employed portfolio. So we don't see much of a stress in that, or either in geography wise or in any product wise. As for the breakup, we currently have 69% is salaried or 70% is salaried and 30% is self-employed. Going forward in the next 2 years, we do have a little scope to push it up a little bit. So 65-35 is what our the FY28 vision or strategy document says. So up to 65-35, we are comfortable, and we would like to keep it below that only.
You're doing ROA now, which is much in excess of what you have guided for, 2 to 2.2%. You're doing 2.55. You're saying margins may come off, but just by a wee bit, maybe 20 odd bips is my understanding of it. Even post-tax, that impact will not will translate to a far better ROA than 2.2. Are you under-promising, likely to over-deliver on this count?
No, only one thing we need to take into account is that in the next year, we have already guided that because of IT transformation that we are planning, our cost to income ratio will slightly go up by about 1 percentage point. Currently, it's around 18.5. It should go up to around 19.5. So that's one small area where, it might be a little impact next year. And obviously, over the years, it'll get a little, it'll come off a little bit. But at least in the next year, that is one aspect we need to take into account. So that's one of the reasons why we have been guiding for 2.25 approximately.
Got it. And that will be a 10 bips impact on ROA. Is just ballpark maths that I'm doing. Okay, fair point. Okay. Mr. Iyer, thank you so much. This has been super insightful. Gives us a great lens into how to look at this going forward. Viewers, 15% growth, maybe not this year, but next year onwards is what has been guided for. 2.25 to 2.3% kind of ROA band is the expectation, and some bit of contraction on margins, complete pass-through if at all there's a repo rate cut. So that's broadly the take with regard to Canfin Homes. Hope this has been productive. All the time we have on this edition of the show. From everyone who puts this show together, thanks so much for watching.